Hello, everyone, and thank you for joining us for the webinar looking at crypto regulations and enforcement. I'd like to say a big thank you at the top of this webinar to the team at Crystal Blockchain, who have been instrumental in putting this session together and in putting together a fantastic panel who I'm sure are going to provide you with a huge amount of insights and information around this specific topic as well. Just as a matter of housekeeping, this webinar is being recorded. We will put some time aside at the end of the session for question and answer. If you do have any questions, please feel free to drop those into the chat on the Zoom function. We will do our best to get through as many of those questions as possible if they've not been answered throughout the session. Just to start off with some introductions, my name is Su Carpenter. I am the Director of Operations at Crypto UK. We are a trade association representing the crypto and digital asset sector here in the UK and support and represent over 160 businesses who are operating within this space. I'm delighted today that we are being joined by several of our members to support on this webinar. I'm going to hand over to each of the panelists to just make a brief introduction to give you some detail about the work that they do, but also some background on their experience within the area of sanctions as well. So Nicholas Smart, I'm going to hand over to you first, if that's okay, Nick.
Yeah, hi, thanks, Sue. Good afternoon, good morning, everybody. So I'm Nick. I'm the Director of Blockchain Intelligence at Crystal. I am responsible for the data collection and analysis that Crystal does as a company. We produce tools and software that's used for transaction monitoring, KYT, and helping people with sanctions compliance. My general background, I was a career intelligence analyst. I worked first in the public sector for the British government. Then I left and then worked in information security for a few years before moving to become a compliance officer for cryptocurrency and digital assets. Yeah, that's all from me. So I'll let you take on to the next one.
Fantastic. Thanks a lot, Nick. Aaron, if you'd like to make an intro.
Sure, thank you, Phil. I'm Aaron Srivastava. I'm a partner at Paul Hastings and London, which is a law firm. My specialist area is financial regulation. We've worked pretty extensively with crypto businesses in licensing and registration applications with the FCA and continue to do that. So one of the very key aspects of the registration process with the FCA is development of financial crime systems and controls and sanctions compliance issues. We've also been working extensively with clients on sanctions issues, particularly since the Russian Ukraine issues arose last year, handling things like ongoing advice about what's permitted, not permitted, and things like off-sea filings and filings with the FCA.
Wonderful. Thanks, Aaron. Great to have you join us. Scott, over to you.
Thanks, Sue. Yeah, hi, everybody. So my name is Scott Sarson. I'm a director in our financial crime practice here in the UK. So I've been with the firm for 10 years. I've been working in the space for about 14, 15 years. We work in our team across the financial crime landscape. But in particular, I focus on our sanctions and screening services for the UK, which I lead. And we work with clients looking at their entire kind of sanctions systems and controls framework. So looking at their governance, their policies and procedures, risk assessment, helping them with their screening solutions and optimizing those. We also do work on behalf of regulators, so Section 166 kind of reviews as well, and other kind of regulatory support. So yeah, that's kind of me. But a lot of work in the sanctions space, working with a vast array of different types of clients, and you can imagine a lot more of that in the last couple of years.
Certainly. Thanks a lot, Scott. And finally, Ankit, if you'd like to make an intro.
Yeah, thanks, Sue. Afternoon, morning, everyone. My name is Ankit Shah. I'm a senior manager within EY's financial crime consulting practice. My background, kind of similar to sort of Scott, is in financial crime risk and compliance. I work with kind of crypto native firms, payment firms, and kind of the financial institutions on sort of the design and implementation of kind of end-to-end fin crime controls, processes, and operations, including kind of matters related to sanctions, and also support kind of firms with the FCA kind of registration process, especially kind of the payment firms and the crypto native firms.
Wonderful. Thanks, Ankit. So there's our esteemed panel. Obviously, a lot of experience between you all. So we're looking forward to some really interesting conversations here. I think initially it would be really good to start by setting the scene. Obviously, it would be helpful to just summarize for everybody on the call really what the sanctions requirements currently are for crypto businesses. So I'm going to come over to Ankit and Scott first to ask if you could explain what requirements currently exist in relation to sanctions for crypto organizations that are currently operating here in the UK.
Yeah, I'll take that one first, and Sue. So essentially, at temporal level, the requirements are exactly the same as they are for all financial services. So specifically, having to identify and prevent any transactions or financial services being offered to sanctioned individuals, entities, or those in sort of comprehensively sanctioned countries. And assets must be frozen where applicable and reported. For obvious reasons, there's been a big increase in the regulatory focus over the last kind of 18 months or so since the Russia-Ukraine situation emerged. We are also now working under a strict liability regime, which is brought in by the Economic Crime Act. So firms can now be held accountable for sanctions breaches, even if there was kind of no intent or reasonable knowledge to expect a sanctions issue. And I would say really what we've got is almost a twin regime, two key regulators, the FCA from a systems and controls perspectives, and OFSI where there are sanctions breaches. OFSI have new and increased powers by the Economic Crime Act. So they are able to, obviously they were already able to fine firms, but they're also not able to publish details of breaches, even if there was no threshold, the threshold was not met to fine that firm. And we've seen that in a recent example just in the last kind of month or so. And that kind of brings us in line with the US model. So OFAC have always had that power to, particularly to penalise firms for breaches. And obviously the requirements for sanctions are not particularly prescriptive. In fact, it doesn't even really say that you need to screen, but everybody understands that screening is the only kind of reasonable way in which to identify the sanctions exposure, or certainly the most effective way to identify sanctions exposure. And the FCA have been much more focused on this, as I mentioned. They started around kind of last year doing what they call the MAP review. So they're starting to look at, from a strategic perspective, at sanctions controls across the industry. And since doing those reviews, they've published their report, which has really kind of brought out exactly what their expectations are. So that includes kind of strong governance, senior management oversight of sanctions risk, and also having controls just kind of localized for UK requirements. So any firm that is, a branch of a US or overseas parent needs to make sure that their controls are localized. Having sufficient controls, so sufficient resources with the relevant skills and knowledge in the sanctions space is another key one. And then screening, obviously, as we mentioned already, is absolutely a key control for them, and in particular adequate calibration of those screening systems, having the right balance of effectiveness and efficiency, and critically also firms having oversight over any third-party providers that might be doing that screening on your behalf. And that's been kind of really highlighted by the fact that the FCA are now testing name screening systems with dummy data. So they're really showing that focus on the effectiveness of those systems. As ever, CDD and KYC procedures to identify sanctions risk are absolutely vital, and the key control to identify any sanctions risk through connected parties or corporate structures. And finally, timely and accurate reporting of sanctions breaches and system controls issues. There's also been an increased focus recently around circumvention. So, firms should be having systems and controls in place to identify circumvention. That isn't necessarily just screening. Screening is obviously, was talked about already, a key control, but isn't the only control. So this means things like transaction due diligence and also even transaction monitoring, which is typically being used for anti-money laundering, but we are starting to see more use of transaction monitoring for looking for sanction-specific typologies. So that's kind of the bare bones of the requirements. I'm going to hand over to Ankit now, and he's going to talk a little bit more about the practicalities of that and what it means.
Great, thanks, Scott. Just building on kind of what Scott said. So one of the kind of the key sort of expectations around governance is good quality MI. And what that means kind of in practice in terms of kind of the expectation that the FCA would have from kind of the firms is that the kind of the management information gets reported, to senior level, including all the way up to the board. Kind of includes both operational metrics and the risk metrics. And what tends to happen is that sometimes, there's a lot of focus on kind of just the operational metrics in terms of, kind of alerts cleared or alerts generated, etc., but not much commentary or not much kind of view in terms of the risk. And that's something FCA kind of, continues to sort of find in the reviews, that the MI is kind of lacking sort of that thing. The additional thing is also, some information around kind of trends or analysis based on, horizon scanning or emerging risks. And I think especially for the crypto firms, I think it's really important that they kind of keep an eye on emerging risks and they're able to kind of articulate kind of the impact of those risks in the management information reporting that kind of is reported, further up the chain. The additional thing is just around the operational capacity and kind of the backlogs. Again, FCA, very, very kind of clear that what they expect to see is a robust sort of, operational kind of capacity plan that kind of clearly sort of sets out, what would the firm do in an event like sort of Russia or Ukraine type of thing, or just a BAU kind of spike in alerts, and whether they have sufficient kind of operational capacity to deal with that, with the rising alert volume before kind of the situation becomes kind of out of control and the firm has kind of a backlog. The final thing I'll just touch on is the testing of screening kind of capabilities, and where especially kind of blockchain analytics kind of tools are being used. Again, a very clear expectation that compliance team are able to explain how exactly the analytics tools kind of address the risks that the firm has identified through their business-wide risk assessment, and not just kind of saying that, look, we use a third-party blockchain analytics tool, and that's it, we kind of covered that way. So I'll kind of leave it at that.
Fantastic. Thanks, Ankit. Thanks, Scott. And Aaron, I just wanted to open that up to you as well. I know obviously you've got some first-hand experience working with clients in this space. Just to add your thoughts there too, just in terms of current requirements.
Yeah, sure. I think going back to the title of the talk about whether how crypto firms are actually affected by what their legal exposure is, and whether UK and other countries like the United States can regulate the crypto market more generally. For example, if there's a crypto exchange in Russia or in another third country, what is the impact of all this stuff? I think the one important thing is that a lot of the sanctions laws can operate extraterritorially, so they apply not only to conduct that goes on in the UK, but a UK person or UK company is basically subject to UK sanctions requirements anywhere they operate in the world. So, in assessing risks, you need to look at your business more holistically. You also need to consider the impact of the Proceeds of Crime Act. So the way, other than the sort of direct things that Scott and Ankit have been talking about, which is, the role of Ofsted and the FCA in a sort of supervisory capacity over registered or regulated businesses in the UK, the Proceeds of Crime Act can impose criminal liability where there's an attempt to integrate money from abroad back into the UK, bearing in mind that the Proceeds of Crime Act applies to criminal conduct. Criminal conduct can take place anywhere in the world and is judged by UK standards. So something that effectively constitutes a sanctions offence under UK law, but the conduct takes place outside the UK, where those assets, the crypto assets or fiat proceeds are thought to be reintegrated back into the UK, that will be subject to the Proceeds of Crime Act. Just picking up on, I think, a point that Scott made, I think one of the game changers in sanctions enforcement and sanctions liability has been the imposition of strict liability. So as Scott pointed out, obviously the principal regulator, if you like, for sanctions compliance, and a breach of sanctions under Sanctions Anti-Money Laundering Act and secondary legislation is a criminal offence. We all know that actually taking someone to court for a criminal offence is it's time consuming, resource consuming, and difficult, but obviously has always had the ability to impose a civil penalty, so through administrative action, which is much more straightforward. And the stakes for firms have been increased, or the risks have been increased, because not only can obviously simply impose a civil fine where they think that there's been a sanctions breach, but they no longer have to show knowledge, intent, or awareness by the perpetrator of the sanctions violation. So you could innocently contravene sanctions requirements and still end up being fined by OFSI. That's a relatively straightforward process for them, as in the Wise case, I think that Scott was alluding to, which concerned a cash withdrawal of just £250 because the allegation was that there was a delay in the firm actually following up a sanctions alert. So I think overall, I think the enforcement risks in the UK are increasing. They're probably not at the scale that they have been in the United States. You also have obviously criminal exposure, and then you have exposure to the FCA, which, as Scott mentioned, can look into systems and controls requirements. But if you're a crypto firm, obviously you have to satisfy the FCA that you're fit and proper to hold a crypto registration under the money laundering regulations, and that could be jeopardized by breaching sanctions. So I think overall there are a lot of tools that are available to regulators. We haven't probably seen them being used at the moment in extensive manner. They can be used, but that might be because that there's delays while things are being investigated.
Fantastic, thanks, Aaron. I think that's been a really good job in terms of setting the scene as to where the expectations lie at the moment. Just very quickly, I have seen there are some questions coming through. We have set some time aside at the end of this session for Q&A for anybody who joined late. Please feel free to keep dropping questions in there and we will come back to those. What I'd like to do now is, I suppose, given the fact we now know what the expectations are, I think it would be really useful now to kind of drill down into some of the detail about actually how effective these sanctions have been within the crypto industry as a whole. And Nick, I'd like to come to you for this because I think you've got some really good specific examples looking at, how effective sanctions have been to date in the crypto sector, and also how these are being implemented, managed, and enforced. I mean, there's a broad one for you to start with, but I'm sure you've got some great examples to share there. So Nick, over to you.
Thank you very much. And I think, the context in which the regulatory tools are clearly in place, and there are plenty of powers that the government and regulators have to, particularly in the UK, to take action against providers who don't comply. But let's talk about the actual sanctioning process and what it looks like in sort of like general, like what we see on the blockchain. So as a blockchain intelligence company, we have a fairly unique position, and because of a public transparent blockchain, we're able to see, and not with 100% certain, not with 100% view, because there are things that we may not know, but we are able to generally get an idea about how active an entity is in any given period of time. And that ability gives us some fairly unique insights into what happens when an entity is added to a sanctions list. So, for example, the US government has been pretty forward in adding crypto asset addresses to sanctions lists to try and control the flow of funds, or at least highlight those problem vendors and their associated cryptocurrency addresses. One of them would be Garantex, which was sanctioned on the 6th of April 2022. Since Garantex was sanctioned, however, they were still able to trade around $30 billion, according to an article in a figure reported in the Wall Street Journal, which would indicate that there is some disparity between what the intent of a sanctioning would be to do, which was to, restrict and constrain a service, against, perhaps what is actually happening in reality. We do know that other sanctions targets, Chatex and Suex, also Russia-facing businesses, were sanctioned. They were nested services on another hosting provider, and they were effectively shut down by this sanctioning activity. And from what we see on the blockchain analytics perspective, it is kind of in some cases, it looks like it's working, and providing a list of cryptocurrency addresses which you are not permitted to interact with by one jurisdiction might seem like the right way to do this. but unfortunately, in reality, it's fairly trivial for somebody to literally migrate their infrastructure onto a new place and continue trading forwards. And what was lacking from OFAC's sanctioning is a continuing update of new cryptocurrency addresses associated with their sanctions targets, which would make screening a lot more effective and a lot easier for those counterparties trying to do it. So that I think from like an effectiveness perspective, like in some cases it works, in some cases it doesn't. Certainly for the targeting of Garantex, it appears to have been ineffective. For other smaller operators who were already on other platforms, it has been effective, and keeping them out of the walled garden sort of side of things. We do have some other interesting things too. So for example, we know North Korea is heavily sanctioned, including by the United Nations, but sanctions against the Lazarus Group, its well-known hacking collective, have been fairly limited in their ability to control or reduce the activity of that group, who remain very much at large and very much capable of what they're doing. And I think there's kind of like two parts to this. One is that sanctions are a fairly slower process, or at least historically are a fairly slow process to go through the checks to become listed. And the second part is that crypto moves very quickly. So there's a disparity between those two parts. The final thing to say as well is that in terrorism financing too, there have been some indications that sanctioning of terrorism financing related targets does have an impact on their behavior, as it makes the cryptocurrency that are in those addresses harder to deal with. And in some cases, some organizations have suspended solicitation of donations in crypto assets because they are concerned potentially about sanctions. We don't know that for certain, but it's implied. So it's kind of a mixed bag. The final thing I want to throw in there as well is sanctions. Cryptocurrency itself is also, it's kind of a weird one in the environment in which it operates. So, for example, we did a very big study on Iran and Iranian use of cryptocurrency, not at like a national level, but like on a people level. Like, how does it work in the day-to-day of individuals? And as we can all attest to, when it's an individual who's based in one of a comprehensive sanctions country such as Iran is, it's difficult for them to get access to major exchanges. They're not going to go and sign up to a Western cryptocurrency exchange, but instead they're going to find ways around it. And we do see there's a secondary market of people who offer to provide money mule services, or who will sell registrations to cryptocurrency trading platforms in a fairly comprehensive manner for as little as $30 or $40. Someone can gain access to one of these platforms. And it is fairly rife. Now, from my side, that's not the government of that country and perhaps a sanctions target directly, like it's not a specific member of, perhaps the IRGC or someone who's achieving that. It's a normal individual citizen in that country, but it still effectively is a way of circumventing sanctions controls, which, again, something as an industry we should probably take more steps to address. I want to conclude then on, like, is it a paper tiger? I think it's hard to say. I think it's a very good way of getting cryptocurrency exchanges within those regions to take sanctions seriously and to do something about it. But on a practical level, I think there's some ways for it to be improved to make it perhaps more effective.
Thanks, Nick. That was really comprehensive. And Aaron, I think this is probably a good moment to pass over to you, because obviously more broadly than just the crypto space, what can be done to make sanctions more effective, and how can this kind of be made to bite a little bit more, I suppose, for the organisations that are being targeted here?
Yeah, I mean, I think it depends on what we regard as being the policy intentions behind all the sanctions regulations generally, and also the focus on the crypto and the Russia-Ukraine issues. I mean, and I think the Russia-Ukraine issues are the kind of litmus test, because they're the ones receiving the most attention. I mean, obviously, we have to, first of all, I think most countries and most businesses realise that there is a limit on what can be achieved. That it is not possible always to regulate what goes on in between Kazakhstan and Russia. If let's say, and I'm using Kazakhstan as an example, not making, just to be clear, I'm not making any sort of statements around whether Kazakhstan's compliance or not. But I think the concern is that there are jurisdictions around the world which are not imposing equivalent sanctions or any sanctions, and that trade is continuing and payments are continuing between Russia, let's say, and third parties in these other jurisdictions which might be regarded as high risk. So it's quite difficult for our laws in this country, or the United States or the European Union indeed, to regulate everything that goes on in the rest of the world. So I think that there is a natural limit on that. What I think the objective has been was to prevent, talking about crypto, was to prevent the use of crypto as an alternative payment mechanism, where there had been a clampdown in sort of the traditional finance sector of let's say mainstream banks, e-money firms, payment institutions using fiat currency transactions, where those businesses might have had more mature screening processes. There may be more transparency as well about where money's coming from and going to in those sectors. And obviously the concern last year in early 2022 was that people would use the Russians or designated parties would use crypto as an alternative payment rail, effectively, to circumvent the clampdown in the traditional sector. So I think that's probably a better way of looking at it, in being realistic about what can be achieved. And I think there has been some success with that, but there's been the introduction of the travel rule, which in the meantime, which I think one of the questions relates to, which also focuses on the need for registered firms in the UK to perform diligence on where assets are coming from and so on. But this is all the linchpin in all of that is customer due diligence, and the point that Nick was making earlier on about what visibility do you have in relation to your own customers and whether they're acting on behalf of third parties, and the expectation of Ofsted, other government entities, that firms will be doing better due diligence on who they're dealing with, provided you can do that and find out who the UBOs are and so on. I think sanctions, you could regard the sanctions having had some success in that, but obviously it's not a comprehensive answer.
No, absolutely. And I think, as you say, it's still a very complex area in terms of actually getting down into that level of detail as well. I think just moving on from that, where we're looking at obviously transaction screening, and I know you've just touched upon this very briefly. Aaron, I'm going to come to you first here, just because of some of the conversations we've had. But when we're looking at the implementation of sanctions for the crypto sector, there's some very specific requirements that have been put in place in relation to that process. So this is in addition to just KYC and onboarding requirements. Could you maybe explain a little bit more to the audience here some of the requirements that have been placed on organisations when it comes to transaction screening?
Yeah, sure. I think so obviously in the UK and across most of the European Union, crypto businesses are present, exchanges and custodians are presently regulated for AML compliance purposes under the MLD or UK MLRs. And the focus a lot of AML compliance is on customer due diligence, and is less specific around what you need to do to perform other types of monitoring, transaction monitoring. There is obviously an obligation under the Money Laundering Directive and Regulation 19 in the UK money laundering regulations to perform, to provide scrutiny of transactions to identify unusual, suspicious transactions. And there's an overarching obligation to take steps to mitigate AML and terrorist financing risks. So it is written in the law, and it's a criminal offence to breach this. You are required, firms are subject to the MLRs are required to do transaction screening, but it's less. What's appropriate will depend on your business. But in our experience with the FCA, and I think they've been pretty explicit about this, is that they expect firms to have where you're receiving assets from unhosted wallets, from blockchain addresses. They expect firms to be using blockchain analytic tools to screen those transactions, and that can be. There's a whole if we go back to think about why was crypto regulated in the first place, it was because of financial crime concerns. So firms need to be screening for things like obviously sanctions issues, but also other types of illicit conduct, associations with decentralized exchanges, gambling, mining, mixers, peer-to-peer exchanges, a whole host of things that firms should be screening for. And I think there are obviously a number of very well developed tools in that regard. I think the important point in the sanctions context is that there's a zero tolerance for any association with sanctioned persons. So as a lawyer, the way I understand it, the blockchain analytics tools can give you an idea of the association of a particular asset with some sort of illicit conduct. And with some types of conduct, the FCA are more accepting that the distancing between the asset and the conduct is a relevant consideration in your risk assessment and what you do with that asset when someone's trying to move it onto your platform, and whether you necessarily have to conclude that there's a financial crime issue just because 80 transactions ago that token may have been associated with some kind of wrongdoing. But I think the important point is with conduct like sanctions and certain other types of illicit behavior, there is a zero tolerance. So any association with a sanctions hit in the life of that token or asset is going to be a problem, and is going to be a problem releasing that asset to your customers. The other thing the FCA have made clear is that they will not approve any applications for registration with the FCA as a crypto exchange or a custodian unless firms satisfy the FCA that they have proper sanctions compliance policies. So it is a big focus of theirs. And the other thing to bear in mind is also that the FCA recently released in September examples of good and poor practice for sanctions compliance, a lot of which is quite relevant to crypto firms as well, around things like management information, making sure that firms understand calibrations used in sanctions screening tools and transaction monitoring tools. One of the criticisms, obviously, that people buy off-the-shelf products from third-party vendors and then don't really understand how the settings of those work, and whether, for example, the settings are set with zero tolerance for sanctions hits, for example. So it's an area that, in our experience, the FCA have a very deep understanding of how these tools work and have very clear expectations around how firms should approach it.
Thanks, Aaron. And I mean, again, a very valid point. I think we'll come back to obviously some of the tools that are available in a short while. But before we do, I know, Ankit, Scott, you probably got some additional points that you'd like to bring in there in terms of, sort of the transaction screening side of things as well.
Yeah, I mean, I think Aaron's said most of it. Only thing I'd add is transparency, obviously key. And you look at some of the regulations like the funds transfer regulation. So having all of the data that needs to be screened and sending that onward with the transaction so that others can pick it up. Data has to be complete and accurate in terms of the payer and the payee, or at least complete for the payee. And I think there are additional controls as well that there's an expectation now in place. It's not just about the screening as well, but the ability to detect kind of circumvention attempts through things like stripping. So if this kind of, I think it's for a fiat currency type of transaction, but if payments have been submitted and rejected and resubmitted with the same information, having those sorts of controls in place is absolutely an expectation. So those are the things I'd add. I mean, I think if you look at regulations kind of globally, it is very much on that transparency point. Thank you.
No problem. Ankit, anything else you'd like to add there?
Just on the travel rule compliance point, really, that the introduction of the travel rule compliance, I think it's going to only increase the transparency point, right? Because it sort of mandates kind of the firms to make sure that there is, minimum information accompanying kind of the crypto asset transfer, and firms kind of needing to make sure that with the access of that information, they are actually screening all of that information to detect any kind of sanction exposure. So looking at travel rule compliance, not just from identifying kind of suspicious transactions, but also identifying transactions that might, be in breach of sanctions would be something that the firms clearly need to, pay attention to.
Excellent, thank you all. No, that's really, really useful information. And I know we just very briefly touched upon here as well, but I think it's a really good point to come back to now in terms of the compliance tools that are available. And obviously a lot of firms will be using compliance monitoring tools. And that's obviously really useful for them in terms of assisting with their obligations in terms of compliance with sanctions. However, there are some very clear expectations, as Aaron touched upon there, from the regulators about how these tools are going to be configured and used. I think, Nick, it'd be really helpful to come to you first, because I think you could give us a bit more insight and information about how risk scoring is actually approached from the analytics and the configuration of the tools there as well. So how can analytics risk scoring help to reflect a firm's risk appetite, and how is the whole risk scoring process actually approached? Can you give us a bit more background and insight there?
Yeah, absolutely. And I think before I sort of like discuss like the blockchain analytics tools, I will be very clear in saying that tools like the ones that we produce are fantastic, you know, and they're really great for enhancing your understanding of source of funds for a transaction. Like, they're really useful for it, but they are not a substitute for good onboarding practices, good internal compliance controls, and you know, the knowledge and expertise that goes along with that. I will also add too that they're not foolproof as well. Just as we work tirelessly to try and understand who the UBO is of a particular business or a new client, you know, they're not infallible. There are ways in which there are shortfalls, as in we don't know about something until it's discovered in blockchain analytics. So if, let's say, there's one particular address that's interacting with your business on a regular basis and it suddenly appears on a sanctions list, it may be that there was no sight of that particular business beforehand. You know, the government has other information which allows it to link that. So often when you hear announcements from sanctioning, there's very quickly a rush, particularly in the media, to try and associate one business with wrongdoing. The reality is that they may have had no idea about who the real person was behind this business because another control measure wasn't effective, or in other cases that they just literally had no idea what was going on with that particular address. To discuss the scoring side then of tools, so they work generally on an aggregation of signals. So what most tools do is they look at the sending entity, and then they look at the other sources of funds that go to that sending entity on the blockchain. So, for example, you might have a wallet that's interacted with a number of high-risk services or sanction services that it's received funds from, and then that will retransmit a signal onto you know, the next transaction, which you'll pick up and see. So, for example, if I have my wallet and I've received lots of money from a sanctioned entity, my wallet's risk score will be elevated or lowered depending on how your system's configured. And that will then give me an idea about how risky your particular wallet is. There is a problem in that if I start a new wallet, a clean one, that has no history to it, and I fund it with something that isn't detected beforehand, there's no history to sort of speak of. And that's where your other control measures really need to be sharp, where you should catch you know, money mules or other forms of illicit activity that aren't in keeping with the client profiles, as you know, you would probably expect from more robust compliance control measures. I think other things that can be done too is there's lots of room for obfuscation, particularly in transmitting signals. So where did the money come from that arrived at this address, which is now sending to me? Another issue you might have too, and we have seen it with sanctions evasion as well as other forms of illicit activity. The person trying to circumvent the sanctions control or trying to circumvent the analytics tool will work out how many transactions back your team is looking and then just add a few more to the distance. So if your team is looking 5 transactions back, or 5 hops, we would call that, back, the target, the sanctions target will just go 8 hops back. And then you'll be oblivious to what's happened. And it is a very simple sort of thing. It's just adding more steps to the chain. But it's really where the specialization of the compliance officers and the compliance team is important. And as I said right at the outset of this, why you still need to have that very robust onboarding process, building a client information pack, understanding what's expected for that business. Does it make sense? And I think, you know, I'm sure the other panelists, I'd love to hear what their opinions are, but how do you, you know, create a good client information pack for a cryptocurrency business at the moment? I think that's really where perhaps the blind spot is in the moment in the industry.
I think so, Nick, and I mean it leads quite nicely into sort of where I could see this question going next. I mean, we've got a couple of people on the call who have done a lot of work, obviously working with clients in terms of setting up these kind of tools and their configuration process. So, Ankit, I'll come to you shortly, but I know, Aaron, you've got a couple of examples, and Ankit, I'm sure you've got some really good examples to come in as well in terms of how you support clients through this process.
Yeah, I mean, I think one of the attendees, Peter's, raised an interesting point as well, and just picking up from what Nick was saying, I think obviously these screening tools and transaction monitoring are part of a sort of a compliance system, and they don't work in isolation. So obviously, what happens when you have a screening tool, it will generate hits, and so you need to calibrate that at the right level. And I wasn't suggesting zero tolerance across everything, but I think there's some types of behaviours that the FCA are less accepting of any association with. So CSAM and sanctions are ones where they have a very strict approach, whereas other types of allegedly illicit behaviour that might be flagged but through a screening process, there may be more discretion around how risk scoring works, and then what is then identified as being a red flag, which could be dependent on the number of hops back in the history of an asset that has an association with the conduct concerned, or how the methodology works. But obviously, once you then have to think about what you do with the output of that as well, and you have to resource that function appropriately to make sure that you can process those hits and investigate whether it's a false positive or a true hit. I mean, the issue that arose in the recent OFSI case arose from the fact that the firm, the one where they kind of did the naming and shaming as opposed to imposing a financial penalty, arose from the fact that there was a sanctions hit generated by the system, but it took the firm, in OFSI's eyes, too long to process that and identify the hit as being a true hit rather than a false positive. And so, I think the methodologies, the risk scoring, what is being elevated through the screening process or transaction monitoring processes as being red flags or alerts that then need an associate compliance person to go and look at that and investigate it, all have to be looked at holistically. And I think unfortunately the FCA with crypto, my experience anyway, has been that they have very high expectations around how all this will work, and then the sort of level of resourcing that will be applied to processing these in the compliance function.
Thanks, Aaron. And Ankit, I'm sure you've got some examples or conversations that you've had with clients as well that can support this too.
Yeah, I think in terms of kind of the screening tools, kind of configurations and kind of the rules set up, my experience is that it's being able to kind of link it back to your kind of risk appetite, right? So if you are like a crypto native firm, or if you are a payment firm who's kind of offering crypto services, you've got to really think about kind of your risk appetite in terms of the types of kind of clients that you're kind of comfortable kind of dealing with, and you really need to make use of your KYC CDD information to really understand kind of a bigger picture about the client profile, what they do, where they're based, etc., and use that information to then kind of calibrate your screening kind of tools. There are two elements. One is kind of the wallet screening, right? So where, for example, OFAC or HFT or whoever has added a particular kind of wallet address, and then you kind of screen that. That to me is fairly straightforward, kind of black and white. I think the issue arises when you've got kind of an individual, who's individual or an entity, who's added onto kind of sanctions list, and then it kind of goes through screening tools, and then it gets sort of potential match, and then the level of investigation you do and how much time you spend on that. And I think that's where kind of the sort of the whole risk appetite and linking back kind of the results of your risk assessment to the configuration becomes really important. So my kind of experience and what I've seen to a good practice is where the output of the risk assessment is clearly used to decide, where we're going to set thresholds to look at kind of the alerts that come out of the screening tools, and being able to kind of explain that back to the regulator kind of really help.
Thanks, Ankit. Was there anything that anybody else wanted to add just on that particular point? And Nick?
Yeah, I think it's a really good point Ankit and Aaron both raised then, which is about risk signals and how we handle them and the configuration of the thresholds. One of the interesting idiosyncrasies of tools like ours is you might have a low risk transaction to a client that is seen as high risk. So like you still have that thing there. You also similarly might have a low risk client. If I go back to my example of people using fake KYC or using a mule account from somebody in a third country to try and sign up to their services, you might have a low risk transaction or a low risk client and then a high risk transaction. And I think that's really where the interweaving of systems together is so critical in crypto. And I think it's where perhaps, again, there is in my opinion, it's like there can be an over reliance on like one source of information to try and cover you up. Like I've got blockchain analytics tools, like I'm covered. Like you really still need to do your homework on who your clients are, and likewise, we've got fantastic KYC, and I'm covered. You also need to do the other way around too. I remember a remark made by Graham Barrow from Dark Money Files, which I think I've said on every podcast about compliance I've ever done, which was, if you take the UNODC's estimates of financial crime, it's 2 to 5% of global GDP. And then you ask anybody in a bank, and I'm sure Ankit, Scott, I'd love to hear you ask your clients the same question is, do you receive 2 to 5% of all your transactions from, illicit sources? They'll probably say, well, yeah, that might get through the net. But if you ask them if that 2 to 5% of their clients are criminals, they'll probably say, no, our compliance service is fantastic and we never have any problems at all. And I kind of feel like in crypto, at least, it's kind of the reverse, which is we have great screening tools, and that's why blockchain is such a great technology, is that you can screen very efficiently, and you can get some really interesting context around activity. But you still rely on like high quality KYC. And I think a lot of crypto firms in the early stages, we look at our legacies, and we're not looking long time ago, like 2017, a lot of them neglected KYC, in the way of either gaining market share or, for a corporate belief about, the rights and wrongs of KYC. And I feel like this is where a lot of current issues sort of stem from, and it remains a problem, I guess, in the industry. But yeah, I do think, again, I will never downplay what we can do with our tools, because it really is quite incredible. And it's quite interesting too that we can look up any service provider that we have data on, and you can see how many transactions they've received from a sanctioned entity, for example, when there's a clear, okay, this address belongs to a sanctioned entity, you've been told it does, you've received 10 transactions from it. Okay, where are your 10 SARs that correspond to the 10 events that you've had here? Like, do they exist? Can you show that? And for a supervision tool, it's fantastic. But it still needs to be part of a wider integrated, compliance program.
Yeah, I think that's where the burden falls on compliance and management within crypto businesses because in the end it involves the exercise of judgment about where you set your parameters and how you staff the business. There was a well-known firm years ago that their sanction screening tool was producing too many alerts, more than they could handle, and they were convinced they were sort of false positives. So they turned off the sanction screening tool because they couldn't handle the volume of alerts that were being generated. This is quite a few years ago. I mean, obviously, no one would do that in their right mind today, but at the time, that was thought to be the right response. Which it wasn't. But I mean, it illustrates the fact that you're in a kind of damned if you do, damned if you don't situation, unless you get the judgment right or having the calibration correct and the resourcing correct. So if you have, calibrations wrong and you're generating too many alerts, then you might get accused of not resourcing your compliance function properly if there's a backlog in processing alerts. And then if it's too low, and you're not generating enough alerts, then you could get into trouble for taking the wrong judgment about where you set those things. So it is a difficult thing to get right, and it depends on the profile of the business as well. A retail exchange is probably going to have more, a different profile to, say, some of the wholesale area.
Great, thank you, everyone. There is another point just to bring up here. I mean, we are getting towards the close and we will come back to some other questions from the audience as well. But a point that was raised earlier on in the webinar is around the requirement on firms to be horizon scanning, I guess, constantly looking at what possible future scenarios are likely to happen and what their preparedness is in terms of the regulator's view for being able to deal with those situations. I'll open this out to anybody on the panel, but is there anybody who'd like to give some context to maybe some future potential risk and what organisations should be aware of in terms of regulator expectations on those companies?
I'm happy to kick off. So, I mean, there's a very clear view, I think, from the regulator at the moment that lessons should have been learned from what happened with Russia kind of last year. So a lot of firms were caught out by the sudden spike in alerts, and we are talking about 1,000 designations in the space of just a couple of months, and a lot of firms really struggled with that. And I think there's many firms struggled with complex escalations going to their FCC functions, just the sheer volume and the sheer complexity of it all, and understanding their risk and being able to identify where their exposure was. But I think there is a view that for a potential Russia 2 situation, whether that's China or anything else that might be on the horizon, being prepared for it and learning from those lessons from last year is really key. So it is things like, how do you store your data? How can you get to your exposure quickly? And how do you resource up where you might have a big spike in alerts?
I think I would add as well is I think just to sort of tail on to maybe not other environments, but also just to sort of follow what Scott was saying there is I think maybe it's how firms have reacted to a lack of information. So if I go back to our example of Garantex, when Garantex was sanctioned by OFAC, the US government provided a list of cryptocurrency addresses across several blockchains to say, okay, right, these belong to Garantex, and you are now to sanction and not deal with these addresses particularly. What I haven't seen yet is any clarification, although I should imagine it is fairly clear, that any other cryptocurrency addresses associated with that particular service are also subject to the same level of sanctions. And I think what I would expect soon is to see the regulators come out and say, okay, we're going to provide you with a name, we're going to provide you with a starter list, but it's really on to you guys to stay on top of this. And I think the onus is on the analytics firms too to make sure that we're doing that. I also wonder as well is that standards for the effectiveness of compliance tools and compliance programs, I think they're still under debate, as in like what's classed as an effective tool, what's classed as a suitable tool for your programs. I think we might see something come soon, and a vetting of the tooling that services use to make sure that they're prepared for it. I think really that's the main things that I see on the horizon. The other thing too is control of transaction monitoring tools as well. If you have access to a transaction monitoring tool, effectively you can see what that particular provider sees about you, right? So you can get access to a platform, and you can look and see what your exposure looks like, and potentially that can assist a launderer. And maybe there'll be some controls around who's able to access blockchain analytics platforms or those kind of things too. Although again, I don't see that in a hurry, to be quite honest with you.
Great, thanks, Nick. Just conscious of time, and there's a couple of questions that have come through, so it'd be great to get through them. There's two that seem quite similar, so I'm going to try and position these together, and obviously whoever feels best placed, please do step in. Questions around what happens if a transaction has been affected and at a later point the entity or wallet becomes sanctioned, or the tokens are passed on to a sanctioned address in a way that suggests that was always the intention. What are the next steps, and what are the actual obligations on an organisation in that scenario?
I can kick off. I mean, there are specific reporting. So if you become aware of, let's say you were holding assets and custody account or an account, and your client was, or the UBO of the client was designated, then there would be a reporting obligation to OFSI. And if they were designated under an asset freeze, then you'd have to freeze the account, because crypto businesses were brought into the specific reporting obligations, I think last June or around the middle of last year, that other financial institutions are required to report to OFSI. If the assets have already gone, I mean, there may be, whether you need to report to OFSI or not would depend on, timing issues. So the sending of the assets out of your platform to a blockchain address or wherever they went to may just not have been detected at the time, but could have been in breach of sanctions, in which case you would need to report that to OFSI as a sanctions breach. And the FCA have also made clear that they want to be informed of all OFSI reports that FCA firms make. So you need to report to the FCA and also to consider filing a SAR with the NCA. So those are the three things to consider. And then what you then do with the asset. If it's a designated person, then you obviously have to freeze the account. If there's any movement in that, you may need to seek a license and/or consent from the FCA to the asset. We do see interest from the FCA in reports that are filed. We don't always see interest or feedback from OFSI, depending on the circumstances, but the FCA certainly, in our experience, reads everything that's sent to them and sometimes have questions.
Is there anything from anybody else to add there, or do we think I think comprehensively covered that one? Fantastic. In which case, again, very conscious of time, I wanted to really finish this session just with an opportunity for each of you to kind of give us your pearls of wisdom before we all close. So I'd like each of you to maybe just summarize for the audience what would be your most important piece of advice, what's critical for crypto firms to consider when they're looking at the implementation of sanctions monitoring and compliance. Now, you've probably got 100 pieces of advice that you'd like to give, but if you can summarize it in just maybe one, that would be great. Ankit, I was going to come to you first, just in terms of sharing your advice.
Yeah, sure. I think one kind of sort of piece of advice you kind of looking for is, I'd say, kind of really clear documentation of your kind of overall sanctions kind of program and controls, and kind of being able to kind of really explain how this control is going to help you, the specific risks that your business kind of faces, right, based on clear documentation of risk assessment. And I think if you have that as a starting point, then I'd say it'd be a good first step. If you are ever approached by the regulator. So I think that would be kind of my advice.
Great, thanks, Ankit. Scott, putting the spotlight on you.
Yeah, I would say don't forget about data. So a lot of money is spent on tools, state-of-the-art screening and case management systems in various firms, but it's all about the quality of the data that goes in. So understanding the data points that you want to screen, the systems that you want to screen from, and making sure that's happening and the data is up to the required standard, and your data lineage, data completeness, data quality is all in order.
Fabulous, thanks, Scott. Aaron.
Sometimes regulatory expectations can be unrealistic. So don't be afraid to exercise your own judgment about things. Take into account what the regulator's feedback is, but you consider that in the context of your business, document your decision making, and be prepared to stand by it.
Thanks, Aaron. And Nick, no means least at all, but definitely last. Over to you.
I think it would be if you do end up with a deposit from a sanctioned entity, don't panic. Like, if you've detected it and you have those controls in place, such as we've all alluded to and discussed, don't panic about it. As long as you take action, you report it, and you comply with the regulation, it'll be okay. Though I would say it's important to ask yourself, why did they come to me? And if you get a lot of those particular results, you probably want to have some sort of review about what's going on with our compliance processes, that I'm the one that they're coming to all the time.
Well, Thank you all. Hopefully this has been incredibly insightful and useful for all of the audience who have been with us for the journey for the last hour, and you have a lot more insight and expertise now. Thank you to each of the panelists, Aaron, Ankit, Scott, Nick, and thank you again to the team at Crystal Blockchain for putting this whole session together. Any information that anybody needs, any questions, please feel free to get in touch, and we will hopefully be making a recording of this webinar available afterwards. So once again, thank you everybody, and thanks to everybody for joining. Good afternoon.
Yeah, thanks.
Thank you, everyone.
Bye, everyone.